What's going on, traders? Welcome back to my YouTube channel. I hope you're doing well, and of course I hope you're having a good week. So today's lesson, we're going to go over a simple strategy that I personally use myself. This is my personal strategy, and I haven't gone into too much details about teaching it as of yet, but this Saturday I will be releasing a 12-week program where I'll be taking on a test group of traders and be personally taught by myself how to trade these concepts. They can be used across all currency pairs, all symbols, and it's very simple with no discretionary trading. We simply will be focusing on trading the behavior of the market and identifying the volume and key points where you can be entering. So look out for the announcement on Saturday if you're interested, but without further ado, let's get on with the show. So traders, we're looking at pound USD here on the 4H time frame, and as part of the strategy, what I really want to go over here is how simple trading can be. Now there's many strategies out there that require price to break structures, to then look for retests and then continuations. There are strategies out there that require you to look for significant patterns that are repeatable to then look to take trades. There are strategies out there that require you to look for certain patterns with, let's say, momentum, which we call breakout trades. Now, one thing that traders struggle with the most is not the fact that they cannot trade. It's the simple fact that there are too many confluences and confusing aspects to their trading that make them question whether they should be entering a trade or not. So what I do as part of my strategy is I really focus on what's happening on the charts. And I'm not just talking from a key level perspective, pattern perspective, breakout perspective. I'm simply just talking about what is happening today. So today I took a pound USD sell, which I banked 3% on, and it was a very, very simple trade. And the reason I took this trade was for these simple reasons. Now, what I want to say is when you're making your trading plan, or as a trader, what you don't want to do is focus too much on rules per se, but you really want to be focusing more on principles, because the principles are what really bind your trade together. Once you have those principles, you can then trade on any time frame you want, and then you'll be able to use those principles with added confluences to execute high probability trading setups. So one thing I want you to notice when you look at this chart here is that we have an area in the market where price failed to break above. Then we'll classify this as a strong push phase in the market. We have a retest here in the market and a break below previous structure, which then we anticipate price to continue bearish. Now, when we look at this, what we're looking at here is an accumulation of candle formations. And when we have an accumulation of candle formations, things can become very, very confusing. Why? Because of the noise in the markets. So when I trade, personally, what I like to do is simply just focus on a single candle's movement. Now, some of you might be saying, well, how can you get confidence from a single candle's movement? But one thing that I want you to really understand, traders, especially as day traders, the single candle movements from high time frame perspective, especially the 4H, the daily, is a complete trend and structure on lower time frames. So if we illustrate that and we isolate these two candles here, what you'll find is when we scale down to, let's say, the 5-minute time frame, you'll see a complete trend. The market has been trending down. When you scale to the 15-minute, you'll see a complete trend that's scaling down. Now, when we head down to the intraday time frames, what we're looking for is almost the perfect setup every single time. We're looking for price to break structures and retest structures. We're looking for price to come back to create 2 wick rejections. We're looking for price to create those doji candles, engulfing candles, and everything else that, we've been taught as a trader. But if that was working for everybody, don't you think that the consistency that traders are finding themselves having now would be a lot better than what they're actually achieving? And I think the clear answer to that is yes. Why? Again, because most traders are looking for perfect entries. So when I'm trading, what I'm focusing on is definitely structure, because that's very important, but I'm also just focusing on the singular candle movements. So let's say in this instance, I'm looking at GU this morning and I can see that the overall sentiment of the market has been pushing bearish. We have a really nice break below 35.11. What we also have here is weighted momentum and shift to the downside. So if we use this as a block and we put this above, we can say very confidently that the market is pushing bearish. If we put the block below, then the weight clearly isn't pushing up because this shift is making the market move down. So that's just a visual perspective in its simplest form. I'm not going to go into too much details about that. But here we see the break below. Now that I know the shift has happened, I've got to understand the two phases of the market when they form a candle formation. The first phase of the market opening is when the candle opens, it will pull back and create what we call a wick. After the candle's created the wick, then what happens is the candle, if it's going to continue bearish, will flip. So the first phase when trading this strategy is to make sure that we're identifying here the phase of the market. This being that the market has created this wick. Once this market has created this wick, then I know that there's a high chance, based on the simple fact that the price creates wicks when the candles open, that the market will continue bearish. So I have this in the back of my mind. Now, once I have this in the back of my mind, traders, again, just remember I'm trading a single candle. I don't care about anything else that's happening on the charts. And one thing you have to remember, you have to be very, very, very clear that you understand this. At some point today, a candle will close bullish and a candle will close bearish. What you can't guarantee is a retest. What you can't guarantee is a break and retest. What you can't guarantee is a double top. What you can't guarantee is a breakout. What you can guarantee is that a candle will close bullish or bearish. So what I do personally is I scale down to my intraday timeframes. And what I'm looking for here is I'm looking for an identifier mark to let me know what is happening in line with the bias that I've identified from the higher time frame. That bias being that the previous 4H candle closed bearish below the level, the wick has been formed, and I'm now anticipating the next candle to go bearish. Why? Because the weight of the market is leaning more towards being bearish than it is bullish. So that weight is pushing the market down. There are other confluences that we add to this that I'm not going to go into too much details about on this session today. But as I said, we are expecting the market to continue bearish. So when I come to the charts, what I'm looking for here is two things. I'm looking for the market to come back to the key level where price is broken to form what we call a key level of resistance and then respect that level. Now, if you don't believe me, we'll clear the charts, we'll mark in this level here, and we'll scale down to a 5-minute time frame. Now, once we scale down to a 5-minute time frame, you'll start to see what I mean. We have a level that's created and then a level that's respected. So I know that because obviously I've been trading for a while now and I understand the connection between higher time frames and lower time frames. But the point is this: the previous candle has just closed bearish below this level. I'm waiting for the market to create the wick, which is this information here. What I'm then looking for is confluences to identify a pattern, which is this level here. If I want to take the trade, then this is a perfect trade to take, because remember, the weight of the market is bearish, the previous candle closed bearish, and I'm anticipating the next candle to continue bearish. But this is not where I took the trade, and the reason I didn't take the trade here is because I came to the charts a little bit later. Now, this is the problem. When traders come to the charts a little bit later, they're extremely scared to enter anywhere along this movement to the downside simply because they've missed the retest or they're waiting for price to come back. But all we do when we scale down is we do the exact same thing. We may have missed what we call the best entry at the key level at 35.12, but what we haven't missed is identifying that the shift and momentum of the market has turned bearish. So with that being said, once this candle closes bearish, I can now almost certainly say that there's a very high chance the next candle will go bearish. And all I need to do during this phase is wait for this candle to start pushing bearish. And what you're looking for is for the market to start breaking the low of the previous candle, because then this is an identifier mark that this support level that is formed, and again, if we go down to the 5-minute time frame, you'll see here this support level that is formed. If it's broken as part of this downtrend, then there's a very high chance that the market will make a new lower low. So when I'm at the 30-minute time frame, I don't need my lower time frames to identify that, but what I do know is that if this low is broken, then there's a high chance that I'm going to win my trade, because the weight of the market is bearish. The previous candle closed bearish on the 30-minute, and I'm anticipating the next candle to go bearish. So this is where I entered the trade. Now, where I enter this trade, it's up to me where I place my stop loss, but in this instance, I place my stop loss above the candle. The reason for this is because price has created the high of this structure, and if the market starts pushing bearish and then turns around and pushes above the body of the previous candle or the wick, then that means that the sentiment of the market has switched to being bullish at this stage, and that means I don't want to be involved in the market. So I close out my trade early, or I just let it hit stop loss. But in this instance, because we had strong momentum in the market pushing bearish from the previous 4H candle, we have the double top formation that we identified on the 5-minute. We also have the previous 30-minute close bearish. There's a very high chance that the next candle will be bearish. And that being said, one thing we can guarantee at some point today during your trading is that one candle will close bullish and one candle will close bearish. So with that in the back of my mind, I entered this trade and I went for a 1-to-3 risk reward ratio trade. Now, as you can clearly see here, it was pretty simple. We managed to get out of this trade in a very short space of time. Now, how you capitalize on this is this, and this is the absolute power of trading these kinds of concepts where they're very systematic. There's no discretion that is involved in trading these concepts and simply just following the momentum and behavior of the market when the volume kicks in. Because when we go to the 4H time frame, you will see where I entered this trade. The area where I entered this trade is when the 4H candle turned red. I use the stop loss placement above the previous 30-minute candle, or the current 30-minute candle that I'm entering, because if the momentum shifts bullish, then I don't want to be in the trade. So it doesn't necessarily need to be about the 4H candle. We do have a concept for that for those that are working. If you want to do that's completely fine. But in this instance, I'm using scaling down techniques and I enter the trade. Now, if you want to take advantage of bigger moves using this concept, what you have to understand is that price is only going to react at key levels. Okay, so if I'm looking here in at the market and I can see that the range from where I'm entering back down to the key level is here, where price can react to, then I don't necessarily need to just go for my 1-to-3 risk reward ratio trades. I can now go for bigger targets back to the key level. So we've just gone from a 1-to-3 risk reward ratio trade to now an almost 7R trade, which is absolutely incredible. And if you want to take it a one step further and you believe price is going to continue bearish with the confluences that you find across the market, then in this instance, you can target the major low here at 33.69, and now we have a 10R trade. And this is how you find high probability trading setups using this concept. And then if we scale down to the 1 minute, you'll now start to discover how traders are able to take trades from very significant or so-called significant levels and get really big risk reward ratio trades using the 1 minute time frame because of these simple principles. Now, I know others trade it different ways, but this is the most simplistic way you can trade it. And as I said, this Saturday, I will be releasing a 12-week program, and I will be taking on a group of traders as part of a test group to teach you the ins and outs of this strategy and concept. You can use this on your higher time frames, you can use this on your intraday time frames, or as you can see here, you can use it on your scalping time frames on the 1 minute. You will be taught by me. You will be taught all the intricacies of this concept. You'll be provided with homework, coursework, worksheets, and everything more. Now, I'm not trying to promote, and you know I don't promote, but I personally believe after 10 years of trading, this concept that I've been trading now for the last almost year and a half, if not longer, has been the reason why I've been able to really elevate my trading and get myself to where I am now. So I just want to share this with you as just a brief overview of how you can keep your trading simple. And as I said, there's zero discretion that's involved in this. A candle will close bearish and a candle will close bullish. Just learn to connect your high time frames with your lower time frames, and then the rest is down to you. The world's your oyster. And I'm not going to lie to you, you'll see across the board here on Euro JPY, it's a trade that we called on the live trading session today, that we anticipate Euro Yen to continue bearish. You can see this bearish move. We also mentioned that we anticipate Euro USD to continue bearish, and as you can see here, we have this bearish move and so many more other trades that we looked at just using these simple concepts. So traders, I hope you found that useful, and of course I hope you spend some time on really digging deep on how to trade these concepts. They're super simple. This is my personal strategy, and I hope sharing it with you will shed some light on your own personal trading. If you enjoyed this video, hit that like button, subscribe if you are new, turn on notifications, and as I always say, continue to trust the process.